Welcome back to the Global Ledger. I'm Justin. Today we're talking about one of the most important numbers, I think, in all of finance. That is the equity risk premium. This is the extra return investors demand for holding equities instead of risk-free assets. You've heard it really 1,000 times. Textbooks teach it as the reward for taking more risk. But that explanation doesn't actually, in my opinion, explain anything. Why does the premium change? Why does it collapse during liquidity booms? Why does it explode during crises? Why do the swings in the equity risk premium often dwarf swings in earnings or fundamentals? Today, we interpret the equity risk premium through the actual machinery of modern finance, through funding, liquidity, hedging, balance sheets, and risk-bearing capacity. Let's get into it. In traditional finance, the equity premium is described as investors requiring high returns to hold risky assets. But that's not really an explanation. That's just a restatement of the phenomenon. If risk alone explained the equity premium, then the premium would be stable, right? So, and this is because human risk preferences don't change dramatically day to day. But in reality, the equity risk premium moves, and sometimes violently. It widens in liquidity shortages. It shrinks when funding is cheap. It spikes before earnings change. It collapses long before fundamentals improve. So if the premium moves before the fundamentals do, it must be driven by something upstream of fundamentals, right? So I think the upstream driver in this case is liquidity. So think of every corporation as a stack of promises. At the top, you've got short-term liabilities, near money claims, secured funding, right? Below that, you've got long-term debt and unsecured obligations. But at the very bottom, equity. This is the residual. Equity holders get paid only after everyone else is satisfied. That means equity absorbs liquidity shocks, funding stress, volatility, margin spirals, tightening in credit, and changes in market-wide risk appetite as well. So the equity premium is really compensation for taking the deepest, most liquidity-sensitive position on the corporate balance sheet. So when liquidity is abundant, that compensation falls. When liquidity disappears, that compensation skyrockets. So let's shift perspective. Okay, so instead of thinking about the risk of equities, think about the capacity of the market to bear that risk, right? So markets don't price risk in isolation. They price risk relative to how much balance sheet space dealers have, how expensive it is to hedge exposures, how volatile funding markets are, how easily investors can borrow against collateral, and how much liquidity is sloshing around in the system as well. So the equity premium expands when the system's capacity to bear risks starts to shrink. And it contracts when the system's capacity expands. So this is why the premium is so cyclical. It's not about psychology. It's about balance sheet physics. And so let's look what actually moves the equity risk premium. I think there is a list here. I'll name 5 or 6 that I think are the real drivers of movement in the equity premium. I'll start, of course, with funding liquidity. When borrowing gets expensive or unreliable, risk-bearing becomes costly. Number 2, I would say market liquidity. When markets thin out, the cost of entering and exiting position increases. Number 3, dealer balance sheets. When dealers have less capacity, they raise the price of warehousing equity risk. Okay? So that's number 3. Number 4, volatility regimes. Volatility increases margin requirements, which would reduce leverage, right? Which would widen the premium. Number 5, monetary transmission. Interest rate floors like IORB, which is interest on reserve balances, and ONRRP, which is overnight repo. That's the facility. Shape short-term yields, which anchors risk-free rates and influence the relative appeal of equities, right? So that would be number 5. Number 6, I would say a really important one would be collateral conditions. So when collateral haircuts rise in repo markets, shadow liquidity contracts and risk premiums widen. Notice what's missing though. Earnings, growth rates, fundamentals. I didn't include those. But they matter a lot. But they don't drive the premium. They drive expected cash flows. So the premium is a measure of market-wide liquidity stress. So why does the equity premium shrink in liquidity booms? Think back to periods when markets were extremely strong. Debt was cheap, repo was plentiful, volatility was low, dealer balance sheets were expanding. Money flowed into equities effortlessly, right? So what happened to the equity premium? It collapsed. Not because risk disappeared or anything like that, but because risk-bearing capacity expanded. Investors required less compensation for taking the residual position in the stack. This is why valuations rise during liquidity booms, even if fundamentals don't change. Cheap money, low risk premiums, high valuations. And that's kind of the line, the course, I should say. But let's look at why equity premiums explode during crises, right? Now think about those types of conditions a crisis brings. So funding markets are breaking, collateral haircuts are spiking, dealer balance sheets are contracting, right? Investors are starting to de-lever. Forced selling starts to begin. In these moments, the equity market isn't suddenly more risky in an economic sense. It's just more expensive to hold. Hedging is expensive. Funding is unstable. Liquidity is thin. Therefore, the equity premium spikes because the system cannot easily carry risk. This is why equity markets crash before recessions become quote-unquote official. The premium is a leading indicator of liquidity stress, I think, in my opinion. We can see the equity premium kind of like a liquidity barometer in a way. So if you want to know the health of the financial system, don't just look at equity prices. Look at the equity risk premium. A rising premium means the system is charging more to warehouse risk. It means funding is tightening. It means volatility is feeding back into prices. A falling premium means liquidity is flowing. Funding conditions are improving, and so on and so forth. So this makes the equity premium one of the most important indicators, I think, in all of finance. Not because it predicts earnings, but because it reveals the conditions of liquidity in the system. And so, of course, we should tie this up with what this means for valuation. Valuation models often treat the equity premium as a static assumption. It really isn't, though. It's a live market price that reflects the structure of liquidity, funding dynamics, dealer capacity, monetary floor settings, systemic risk appetite, volatility regimes like we talked about. So if the premium moves, your discount rate moves. If your discount rate moves, well, your valuation changes, right? Even with identical cash flows. So understanding the risk premium is understanding how the market prices the cost of bearing uncertainty. I want to thank you for listening to episode 42 of the Global Ledger. We reframed the equity risk premium, not as a psychological measure of fear, but as a liquidity-driven price emerging from the structure of the financial system. In episode 43, we'll continue the valuation arc with debt versus equity and why capital structure lives inside the money system. Once again, I'm Justin, and thanks for being here.